Hey folks, Shawn over at the Annuity Expert. In today's video, I'm going to show you how to maximize your pension's payout when you retire. Okay, so when you retire and you have a pension as your employer retirement account, you typically have one of two decisions to make. Do I take the lump sum payout or do I take the pension's monthly benefit? Okay, take the monthly benefit, you're using the pension's annuity basically to give you a income for the rest of your life on a monthly basis. And outside of providing you a guaranteed income for the rest of your life or the rest of you and your lives, you plus your spouse's lifetimes, you give up a whole lot. Number one, you lose control over all your hard-earned savings. Meaning when you start the income, there's no turning back. There might not be little to no death benefit there. You're not going to earn interest. You're basically just getting a paycheck as if you were still working. And there's nothing wrong with that, but it is extremely limited, right? Especially if you don't have enough liquid assets outside of that pension, okay? So how do you maximize your pension payout? Well, you're going to get a list of payout options. You're going to get a life-only payout option, and that's going to pay you with the highest income for the rest of your life, you, the pension owner's lifetime. When you die, the insurance company keeps all the money. So for example, for government employees that have a thrift savings plan, they're going to use MetLife to give them an annuity payment for the rest of their life. When they die, MetLife keeps the rest of the money, and there's no death benefit. Okay. Then there's life with some sort of guaranteed period certain, meaning if you die within the guaranteed period, your beneficiaries will continue to get the payments for that period, and then the payments stop after that guaranteed period. Then there's joint survivor, where it pays for the rest of your life, plus your spouse's lifetime. There's cash refund or installment refund, where whatever's left when you die, whatever value that the pension's worth at the time of retiring will be refunded to your beneficiaries. So for dumb math, you have a $100,000 pension, you spend $20,000 in annuity payments while you're alive, you get hit by a bus, your beneficiaries will inherit the remaining $80,000 either in installments or cash refund. But to really maximize that, if you're going to go that route, take the life only payout and get life insurance. And I say that with a huge caveat. Apply for life insurance first for the amount of the pension, okay? And then once you get approved and you can afford to pay the premiums, whether that's for a fixed period of time or for the rest of your life, if you want permanent life insurance, basically whatever you can afford, get the life insurance, get that intact, then choose the life only payout. This way you get the highest payout, and then you'll have a tax-free death benefit that will be passed down to your beneficiaries. So for example, let's just say you have a $500,000 pension, okay, and you're taking a monthly benefit. Well, go get a 10, 20, 30, 40 year, you probably at the age of retirement can't get 40, but let's say if you can get 20 or 30 year term life insurance policy, you come here, you enter in the quote, give your status, and then the idea is, if I plug it in, so I go 500,000, and let's just say I'm born, let's say 1965. No, let's go 1965, male, non-tobacco, we'll say standard plus 20-year term. And you view your quote, and then you say, okay, so I can get a 20-year term, and it'll cost me $337.75 a month, seeing that everything's perfect, right, on your medical background. So then you take the highest payout that you can get possible, because your pension's worth $500,000, and so you get the highest payout. You die, the annuity payments stop, but then this $500,000 tax-free life insurance death benefit then pays out in a lump sum to your beneficiaries, right? So no harm, no foul in terms of losing money to any sort of life insurance policy. There is a better way to do this in most scenarios, not all, but most. You take the lump sum option, and then you roll it over into an IRA annuity with a guaranteed lifetime withdrawal benefit. And you start the income immediately, and you get a similar or higher payout depending on your age. And then you retain control of your IRA annuity. So it's out of the employer's hands. You're going to be able to earn interest. You're going to get the contractual guaranteed income for the rest of your life or the rest of your plus your spouse's lifetimes. Anything left over in the account will go down to your beneficiaries in a lump sum automatically. And then if your house burns down in the future, you get hit by a bus or get cancer, you have the choice. That's the key thing. You have the choice of canceling the annuity contract, where the monthly benefit option, you don't. So the idea is you roll over the lump sum option from the pension into an IRA annuity with a guaranteed lifetime withdrawal benefit. You can run your quotes here at the Annuity Expert. You can do it anonymously, and you can run as many as you want. And you get the real-time payouts. And then if the payment is similar or better than the pension's payment, then it definitely makes sense, right? And then what you do is you go here and you buy a life insurance policy on top of it, right? Assuming that the life insurance premium is affordable. You know, you might be able to afford $337 a month for the next 20 years, right? You may not. If you can't, then what I would recommend, and let's say you have a surviving spouse. Let's say you have a homemaker as your spouse, and you either are too unhealthy to get life insurance or it's too expensive at this point. What you would want to do is you would have to inquire to the Annuity Expert, because it's more complex on running a joint life payout. But essentially what will happen is you sign up for a joint life payout on an IRA annuity with a guaranteed lifetime withdrawal benefit. It will pay the same amount of income for the rest of your life plus your spouse's life. So you get hit by, let's say you're getting paid $10,000 a month, okay? You get hit by a bus, your surviving spouse gets $10,000 a month until that person dies, right? So there's no reduction in lifestyle from a financial standpoint when one spouse dies. The paychecks just keep coming, and you still have the ability to have control over your money and earn interest in a lump sum death benefit, right? And then this way, because you can't afford the life insurance, or you're just a hyper diabetic that can't get life insurance, this is a good compromise because it's going to give you this income that's fixed for the rest of both of your lives. There's no medical underwriting involved, and you don't have to buy anything in addition to that. And then once both you plus your spouse dies, whatever's left in the annuity's account value will go down to your designated beneficiaries in a lump sum. So pairing life insurance with your pension is a great idea. It gets more money into your bank account in most scenarios while you're alive. Your surviving spouse is protected. A better idea is to roll over into an IRA annuity so you have control over your money. And if you want to get life insurance in addition to that, you can as well. But if you can't, joint life payout on a guaranteed lifetime withdrawal benefit is the best way to go. And then if you got any questions, leave a comment below. I'll answer them over the next couple of days, or you can contact us at the Annuity Expert and we can help you out from there. Hope this helped. Hope it wasn't too long-winded. But like, subscribe, and we'll catch you on the next video. See ya.